All right, welcome everyone. We're just going to start maybe a minute and a half late so that we give everyone a chance to get into the meeting.
Definitely filling up.
Oh yeah. Yeah, I think we can probably get started now. I'll just jump into an intro, and we'll leave a couple more minutes for people to join anyway. So yeah, on behalf of the CFA Society Winnipeg, welcome everyone to our virtual speakers panel. We're calling it the Introduction to SPACs versus IPOs. My name is Vivek Maharaj, and I sit on the CFA Society Winnipeg Programming Committee. So for those who don't know, the CFA Society Winnipeg has served the Winnipeg investment community since 1952 by promoting ethical and professional standards within the investment industry. Our society is an active participant and innovator within our international organization, the CFA Institute. We're also a member of the CFA Societies Canada, which promotes advocacy efforts to our regulators. And the CFA Society Winnipeg provides our members with professional development and educational opportunities, job placement services, membership and networking events, and informational events like today's. Unfortunately, our networking events have been cut down a little bit lately, but we hope to get back to that soon. So today's discussion, it's going to offer both an introduction and an in-depth perspective of the world of special purpose acquisition companies, which is a method of issuing capital that's rapidly increased in popularity over the past few years. So over the course of 2020, blank check companies raised over 80 billion. And as of late March, so about 3 months into 2021, that figure had already surpassed 70 billion year to date. So it's going to be another record-breaking year for sure. It accounts for over 70% of the market for IPOs. So if you haven't heard of SPACs or you feel largely unfamiliar, you're definitely not alone. But luckily, we've got a panel of experts with us today that will get us up to speed and help us understand how they work, the commonalities and the differences between them and IPOs, and why they've emerged with such force. So firstly, with us today, we have Brian DeLucia. He's a managing partner of Arrivato LLC, which is a single-family office that's focused on land and building development in the retail industry. We've also got Travis Dowle joining us. He's president and fund manager of Maxam Capital Management Limited. He founded the alternative investment firm in 2009. We've also got Andrew Lom, partner in the New York office of Norton Rose FulBright US LLP. He's joining the panel, and Andrew is the co-head of the firm's asset and wealth management business group for the US. And lastly, we have Tom Savage, portfolio manager of merger arbitrage at Picton Mahoney Asset Management. Tom has an extensive background in alternative strategies, specializing in merger and event-driven arbitrage. And of course, moderating the panel today, we have James Burron. You all probably know James at this point. He's the president and co-founder of the Canadian Association of Alternative Strategies and Assets. So James has held that role held roles in institutional sales, fund of hedge fund structuring, as a product manager, and as an investment advisor. So welcome back, James. Thank you all very much for joining our panel today. And James, I'll pass the mic over to you.
Great, thanks, Vivek.
Yeah.
And I can't wait to fly into Richardson Airport again because I'm kind of getting withdrawal symptoms here, but we'll be there sometime again soon. So yeah, we have a coast to coast panel, 2 Vancouver, 2 New York. Although I don't think Brian's in New York right now. I might be in Pittsburgh or Philadelphia. But so we're going to do, we're going to talk about SPACs, we're going to compare them to IPOs. We're going to talk about all that great stuff and some of there's been some new, like it's been in the news over the last couple of weeks or a couple of days, actually, some rules from the SEC. So I'm sure our friends at Norton Rose will have some color on that. So let's start with intros, and we'll start with Brian. And so Brian is call him the money of the group. He's a guy who tells it like it is, and he's kind of the quintessential investor that you kind of win over to get into SPACs and why do these things work. So let's hear about you, Brian, and then we'll go into the other self intros.
Thank you, James, and certainly look forward to seeing you in your travels again when you come to New York.
Yeah.
Anyway, my name is Brian DeLucia. I do sit in a single family office, and I'm also on the board of a few fairly meaningful sized family offices as well. My career mostly has been centric in the real estate sector, both in land and building development over the years, and continuing these days, with development strategies throughout the southeastern United States and Texas, kind of following all that underserved markets right now with housing needs and with all the job migration and population migration that is occurring the last several years, and also have a lot of experience in telecom, manufacturing, logistics, and transportation, and overall, we play active role in a lot of these different sectors, as well as doing some consulting work in other, traditional lower middle market operating companies as well, helping out other families and asset owners.
Very cool. So you've seen it all. It's fantastic. Let's go to Travis at Maxam, one of our West Coasters. Tell us about your fund and you.
Sure. Thanks, James. My name is Travis Dowle. I am the founder and president of Maxam Capital in Vancouver. As James mentioned, we manage 2 funds, both in the alternative strategy class. The Maxam Diversified Strategies Fund, our first fund that we launched in 2009. That is an event-driven long-short fund, special situation focus with a net long bias. And we also manage the Maxam Arbitrage Fund, a fund in which we engage in traditional merger arbitrage, other risk arbitrage strategies, and SPAC arbitrage, which we'll talk about on the panel today.
There we go. Thanks. And I'll go over to Tom. Tom's similarly longtime veteran of the field. Let's hear about your story.
Yeah, ditto to what Travis said. I'm Tom Savage. I'm
almost the same address.
Yeah. I'm also in Vancouver. I'm a partner and portfolio manager at Picton Mahoney Asset Management. We're a Toronto-based investment firm, 16-year history, 100 employees, about $9 billion under management. So one of the largest and longest standing alternative managers in Canada. I cut my teeth in the arbitrage space, working on the proprietary trading desk at CIBC for many years, and then spent a decade at a firm called Vertex One, which was a Vancouver-based alternative investment manager that was acquired partially in 2020 by Picton Mahoney.
Very cool. Thanks. And now our resident lawyer on the panel, Andrew Lom.
Thanks, James. Hi, everyone. It's good to be here. So I'm Andrew Lom. I'm a partner and I co-head the asset and wealth management practice for the law firm Norton Rose FulBright. And in that, I've done a lot of fund formation and private equity work. And so SPACs have become a natural extension of private equity in many different ways. So I'm happy to talk to you today about that.
Very cool. Thanks. Yeah, as Vivek said, it was 80 billion last year and 70 billion so far this year. So you guys must be just rolling in the new prospectuses and new legal work. So let's hear it from the horse's mouth here on what is a SPAC for those of us who haven't blown up on Wikipedia yet, and kind of how does it differ from an IPO? Is maybe we'll get it from your side, and we'll go around the table too. Start with Andrew.
Sure. Okay. So a SPAC, it's a special purpose acquisition company. And so you could think of that as a public company whose sole purpose is to buy some other company. And it has a particular life cycle, which is relatively set. So you have a sponsor group, which generally is made up of the kind of people who would be doing private equity investments in the first place. They come together, they set up the company, they work with the underwriters to do an IPO of the SPAC and raise however many hundreds of millions of dollars. And once they do that, and while they're doing that, they may have an industry focus or something, but they are not allowed to have a target yet. So it's an open slate, so to speak. They raise the money goes into a trust fund and basically sits there in the trust fund until the SPAC has found a target and actually closes on the acquisition with the target. Usually the SPAC has a 2-year period in which to do that.
Mhm.
So the public investors in the SPAC's IPO are there to back the sponsor team of SPAC in that search for a good target company. And the sponsor team goes off, they find a target company, and then once they've negotiated the acquisition of that target company, there's another public filing. And the shareholders of the SPAC at the time, public retail investors, institutional investors, whoever that happens to be, those shareholders have an opportunity to vote yes or no on the acquisition.
Mhm.
That's very important. And so in the course of that vote, the SPAC has to give what is essentially public company level disclosure about the target. And this is why you'll hear that a SPAC is a way for the target to do an IPO, right? The target provides those financial statements and other disclosures so that the public shareholders can vote yes or no on the target. And then there's a merger between the target and the SPAC, and now the target is the public company in place of the SPAC. And at the same time, very often you'll see what's called a PIPE, or a private investment in public equity.
Mhm.
And that's another group of investors who are putting new cash in alongside the acquisition. So the PIPE investors will have an opportunity not only to be willing to support the sponsor group of the SPAC, they also know the target on a confidential, non-public basis. They're writing their check because they believe in the sponsor and in the target. That's very important because many of the public shareholders will look to the success of the PIPE and say that that's an additional, sort of diligence item on the quality of the target. So that's basically the life cycle. You have a sponsor group coming together, doing an IPO to raise cash that then is spent along with cash from the PIPE to buy a target. The target, the sellers of the target also get stock from the SPAC. So this is not an all cash deal. It's actually mostly a stock for stock deal. And most of the cash gets reinvested to grow the target. So the sellers of the target are not cashing out, generally speaking. And you have a public approval process for the acquisition of the target. And then the deal hopefully closes. And now you're off with a public company. If that doesn't work, then you have a 2-year period generally again. And the sponsor has at least a second bite at the apple. They go out and they try to find a second target and actually close on that instead. And one last piece, which you've probably seen in the papers in the last couple of days, is about the warrants. So the motivation for the sponsor to do all of this, and for other investors too, but the sponsor ends up with a greater share of the company compared to the cash that the sponsor has put in on day one. And you could think of that in some ways like the carried interest or the performance fee that a private equity fund manager gets paid from the private equity fund. But
Mhm.
what's interesting here is the sponsor gets paid most of that for closing the deal, for acquiring the target, not necessarily for the long-term success of the business after the SPAC M&A deal or de-SPAC transaction actually closes. And so some people view that, as less alignment than you might have in some other investment vehicles. So that's sort of the life cycle to kind of, level set, what we're talking about here when we talk about SPACs.
That's awesome. Thanks, Andrew. That's really great. Like, 'cause there's all those things of pipes and the other, and we have a few more wrinkles to put in some of the questions here. So that's fantastic. So where do you come in, say, Tom? Like, when you're looking at this, where do you come into the life cycle? Are you with the sponsor in the beginning, or is it just once this thing hits the market, you guys are into the trade, or when do you start researching, when do you pull the trigger, and when do you get out, sort of thing?
Yeah, all of the above, but the most traditional way for somebody like myself to get involved is at the IPO stage of a SPAC. And that's the point at which, we're buying a SPAC unit. A unit consists of a common share and a fraction of the warrant. Almost all SPACs price at $10. And as Andrew mentioned in his comments, that $10 per share, which might be, $300 million total, goes into a trust account at JP Morgan Trust, where it's invested in US government T-bills with a maturity of less than 6 months. And you have a SPAC life, as Andrew said, of 2 years. So we have this publicly traded vehicle in the form of a unit, a common, a warrant, that has a sort of unassailable right to $10 plus interest 2 years from now. And no SPAC, and there's been hundreds of SPACs going back to the 90s, has ever failed to return that trust value at its maturity or upon the closing of its business combination.
Mhm.
And so from a downside risk mitigation perspective, as an arbitrage investor, that's about as strong as you can have in a publicly listed vehicle. It's fully collateralized with AAA US government T-bills. And yet you have prices that aren't necessarily always $10. They can trade at a premium or they can trade at a discount, because the market is a market, and people can value that $10 claim at different prices on different days, depending on the market conditions. And so that gives rise to arbitrage opportunities for us to acquire shares at discounts, or to acquire shares at trust that have attractive optionality, to monetize warrants. I actually went through a list of what exactly is SPAC arbitrage, and we had a client ask the other day, like, list all the different types of trades you've done in the SPAC universe, and within arbitrage only, and there was 8 that I could rattle off the top of my head. So 8 different types of arbitrage trades.
That's a great book title right there.
Created by the structure, and 4 different kinds of fundamental trades created by the SPAC structure. So it's a very fruitful harvest for us to go digging from an arbitrage perspective.
Very cool. How about your side, Travis, across the street there? Do you do these? Do you have the octo strategies, or more or less, or? And then, like, how does the warrant fit into this? Like, is that? I guess, do you guys hedge that at all, or what's your idea there?
Yeah, thanks, James. Yeah, I mean, I'd echo all the comments Tom made there. And actually, we're just in the process of changing the name of the Maxam Arbitrage Fund to the Maxam Octo Arbitrage. No, I mean, Tom laid it out beautifully. I mean, there are a number of different strategies you can use to generate a very attractive risk-adjusted return. I mean, it's so unique that you have a defined downside, a put, if you will, on the investment that you make as a SPAC investor. One thing I would add to that and point out, and we can get into more general discussion of this on the panel here, is, and actually I'll jump back a sec. I think the numbers that I'm seeing for 2021 in terms of the record SPAC issuance this year is over 300 SPACs this year to the tune of about $100 billion. And that's versus 248 last year at around the $80 billion number, only just under 60 in 2019, which itself I think was close to a record. So, I think the liquidity injected into this market environment, or that's available and have been injected into this market environment, plus the risk appetite that we're seeing in this market really lends to why we're seeing this record SPAC issuance. So there's just, it's been great to have a big opportunity set like that to take advantage of it from an arbitrage perspective. I think likely similar to Tom, we've approached it. I'm always careful when I'm talking to our investors and prospects about our fund in terms of what we do in SPAC arbitrage, and it's absolutely arbitrage transactions where we're investing where we've got defined downside. We like to buy either on IPO, where you get the unit and you can split off the unit and essentially manufacture yourself a lower purchase price, and you still have that redemption value at the $10 per share at the end of the day, creating yourself a positive return, and you're still exposed to the upside optionality of something exciting being announced, and which names like DraftKings or Nikola, some of the EV car companies and these new companies being announced as vending in or IPOing into these, merging with these SPACs that have created, an opportunity where it's a heads I win, tails I win a bunch more type of proposition, which is very attractive. But, I think one important thing to point out is, for us, it's the price relative to the redemption value, price of the traded unit or common shares relative to the redemption value, which is essentially your put price, that is really important from the arbitrager perspective. So you won't see us, for example, owning a SPAC that's trading at a 20-30% premium to trust value. At that point, you're making either a fundamental bet on the SPAC sponsor's ability to find an attractive deal, and hopefully it trades higher than that. We don't want to hope. We want to have very defined downside or a positive return defined in the transaction that we're exposing ourselves to.
Would you short that kind of trade if it was 20% above, or just say, no, we're just not going to play in that area?
Yeah, not in our arbitrage fund, but in our other fund where we'll use different strategies. That's something that we have done. And actually there's a big hedge fund in Europe called Marshall Wace that has just been in the headlines the last couple of days about one having profited on the long side, and now they're looking at SPACs on the short side. And I'd say the SPACs they're looking at on the short side, again, these are companies that are either already announced the deal or post-deal announcement, where it's an investor's making a fundamental bet on whatever company merged into the SPAC vehicle, which is, again, very different than what an arbitrager is looking at.
And then as an investor in the SPAC, is it like you get a put option when they say, hey, we're going to buy this EV company or something like that, and you just say, I'm out, give me my $10. I bought it at $9.50, I'm out at 10, done. Yeah. Or is it that easy? Like, maybe Andrew has a thing on this too.
Sure, yeah, Andrew can go ahead.
Seems like a great arb.
Well, yeah, I mean, it sort of is that easy. So as part of that shareholder vote before the closing of the M&A deal, you do have the option to redeem. And so you lose your common share, you redeem from that trust account. And what that means for the SPAC and the sponsor and everybody else who's still there in the system is that your $10 is gone. So when you're negotiating the deal with the target and you're talking to the investors in the pipe, and even when you're giving your disclosure for that shareholder vote, you have to take into account the potential for some of the money to leave the system.
Right. So how about to you, Brian? You've heard all this for 20 minutes on how these things are structured, how they work. Obviously, you got a big real estate background, but you must see everything with the family offices you're associated with and your own. So what's your take on this? And, is it something that you guys would look at, or is it, what do you think?
Yeah, I'd be certainly happy to give you some insight. I mean, I definitely see a lot of, businesses over the years, just, like I said, traditional operating businesses and And then naturally sitting in the family office chair, you're introduced to a lot of, venture capital situations and talented entrepreneurs and various different degrees of, fund managers. And, it definitely, and I think also just from doing business in general allows you to draw a lot of different conclusions. And I guess, without getting technical, I'll try to keep it, I guess a little bit more on the simpler side to complement the discussion. But, I look at SPACs. I mean, it's a niche vehicle that, over the years has been a very effective, I guess you would say, vehicle for a specific demographic out there. And I equate this to, going back like 15 years ago when we started getting into here in the United States anyway, that, the residential mortgage crisis where we had with the subprime mortgages and the adjustable rate mortgages. And at that time, adjustable rate mortgages, ended up creating the, played a big role in creating, the crisis here in the U.S., in 2007 through, 2009. And, when I look back on that, the adjustable rate mortgage was always a good product, but it served a need for, and it was really meant for a very small specific demographic, like 1% of our society who, ultimately was high income earners who were, moving maybe every 3 or 4 years, 5 years on job transfers. And I look at SPACs in much the same vehicle, as adjustable rate mortgages. All of a sudden, people started using these, or like mortgage professionals and banks and everything, as a vehicle to get, to bring the masses in with a, kind of a carrot with a low, the low interest rate and everything like that, without looking ahead and what people were actually getting into. And you ended up bringing the masses into a product that they weren't suited for. And I think a SPAC is, in a lot of ways can, I look at very similar. I mean, some of the positive things is, it's a very streamlined, way to go public compared to go an IPO route. And as an investor, there's some very compelling entry points, into, some fast growing companies, however, now, I said now we have this follow the herd mentality suddenly that has grabbed the industry, similar to, what we've seen in some of these other flavor of the years out there the last 4 or 5 years in the, family office and private equity and every, sectors. I think now that we're getting into bringing the masses in, we are going to see a lot of failures. And I think some of the, some of these, opportunities where we're going to see failures is, and just providing just this perspective is a lot of companies and especially their CEOs are really not fit to go public or fit to be a CEO of a publicly traded company. And I'll add myself into there. I certainly would not be a good fit to be in the CEO chair of a publicly traded company. But also,
what?
and I think also, the other thing is, now that we're getting into, this mass adoption and this follow the herd, type of, stage, we're going to start seeing more riskier, companies, and a combination also of less seasoned investors getting involved in different SPACs as well. So I think, there's going to be where, we're going to have that buyer beware, and just some of the areas where we could start seeing a lot of failures, especially, because we're going to reach that bubble. And, and it's very similar to what we're seeing, like in the, the NFT sector, where all of a sudden there's this huge craze, and over the long term, I think there's a lot of viability, and people are going to make very, very strong economics out of that. But when you have the masses running towards something, it's going to create this bubble effect, because, you're going to run out of, the high quality opportunities to put into the vehicle. And then suddenly things come to a halt, or you start, seeing, like I said, a lot of failures because you're stretching to bring people into situations where really there isn't a natural fit. So I guess that's some of the perspective that I can offer, which I hopefully makes a lot of sense to everybody.
So not totally a cheerleader. That's good. But but obviously, you see all this stuff. So how about you?
Well, there's pluses and there's
Yeah.
positives and downside to everything, and so I wanted to kind of break some of my perspectives.
That's cool. What do you say that maybe for Travis, like the herd, is the public into this stuff, or is it that big compared to everything else? And then how do is it mostly professional investors like you and Tom that are in these sorts of trades, or is it more has it gone retail where people are using their discount accounts and like, hey, I'm going to get into this new SPAC, I'm going to trade this thing like the next crypto kitties or whatever is going on?
Yeah, I think, if I think about, breaking it down to which investors are active in different types of strategies, you've got, professional investors, investment firms running arbitrage strategies like Tom at Picton and myself at Maxam, very specific focus on a strategy where you can define your downside, create a very attractive risk reward arbitrage investment. I think part of the attractiveness and the
我上个洗手间再过来。
Sorry, I'll mute her.
I think you're seeing a ton of retail investor activity in SPACs. I would make an educated guess that most of that is around SPAC speculation and not SPAC arbitrage. Just like everybody wants to be in a hot IPO, you're essentially buying an IPO with a listed SPAC before you know what the company that is IPOing into it is going to be. So you get some of these well-known SPAC sponsors like Bill Ackman or Chamath, the Chamath Palihapitiya. Let's see if I can say that name right. The king of SPACs, ordained king of SPACs out there by himself, or others, created massive amounts of wealth. But the SPACs that those gentlemen trade at huge premiums to NAV before they've announced the deal, just on the hope and excitement that it's going to be a company. So I think you've had a lot of FOMO, MOMO, throw a few other acronyms in there in the space, and it's been fascinating. And that's why you've seen record issuance of SPACs. Andrew went through the very attractive structure and terms for SPAC sponsors. And they can put up a finite amount of capital, and if it works out really well, they do extremely well. On the other hand, unfortunately, history's been littered with companies, and it's typically early stage, high growth companies. Some are pre-revenue, some are pre-product even, that go into, not a lot pre-product, but some are pre-product, certainly pre-revenue, that go into these vehicles, and they're venture stage companies. So huge amounts of volatility, and success or failure is not guaranteed either way. So to be shorting some of those at astronomical valuations where some of them trade, post deal announcement, that can make sense. And that's why we saw a dearth of SPAC issuance for probably a decade until recently.
Oh, it's been going on that long, eh? So what have you seen, Tom? Is this the peak SPAC already, or is there more to come?
I would say we've had peak retail interest in SPAC already. That's all in the rearview mirror. I mean, I've been involved in SPAC since 2008, and for the first 11 years or whatever, I never would have dreamt that retail investors would ever care about SPACs. This is always sort of a financial backwater.
Yeah, that's what I heard about.
Small number of accounts that cared about these. Was a sleepy mid-single digit rate of return arbitrage strategy that appealed to us and fit well within our sort of mandates. We always knew we had lots of upside optionality, but would never pay for it or expect it to pay off. And then in 2020, it was really the first time we saw retail get involved, whether it was post de-SPAC announcements or speculating pre-announcement on business combinations. That was really new. That's what drove our outsized return from our arbitrage strategies last year and in January of this year. That's now, I would say, all in the rearview mirror. I mean, just while we were talking, I got an email talking about just how low the retail participation in SPACs has been in the last week. The volumes are way down.
Oh, wow.
You know, it could potentially come back, but I think there's quite a low probability. I think retail did get burned on something. You know, Lucid Motors was an example of one that really grabbed the headlines, and that was a SPAC that traded from $10 to $60 just on pure speculation of an EV transaction. And I think that's one that, and then now it's back at $20, and so a lot of retail money has been lost. And I think, you know, hearing through sort of the back channel diplomacy with the SEC over the last few weeks about what's actually been going on is that, you know, they do feel that retail investors were hurt from that specific transaction, and that the sort of warrant accounting and noise that we've heard in the last week or two from the SEC has been a convenient sort of rallying point for them in order to push pause on the market. But their concern isn't really about warrant accounting, which is a pretty fringe concern. It's really about how do we hit pause on the market and make sure that retail investors aren't being taken advantage of, that they have the knowledge that they need to. And so we'll see what happens out of that, but I would expect that you know, that's sort of a multi-month process, not a week or two kind of solution. And so you know, the new issuance of SPACs has really been on pause for the last couple of weeks as that's being resolved, and it might be on pause for a further few months as that's being resolved. But you can see in the marketplace today, in terms of where things are trading, that sort of massive speculative retail bid that we saw in SPACs in 2020 and early 21 is gone. SPACs are trading back to where they used to trade for 10 years before that. You know, around a common share looking for a deal with a year left, trading around $9.80 vis-a-vis a $10 interest. That's a pretty normal price level. What was abnormal was when you had, you know, SPACs trading at $12 just because, you know, Chamath gives good CNBC.
Wow. So has this retail in and out kind of been for professional investors like a blip? It's like, okay, retail came in, got burned a bit, and they'll be out, and so then it's back to the usual $9.80 instead of 12. And after this, it's like level heads, and it'll go back to being not a backward, but like, you know, like a cottage industry where a few people are just making arbitrage profits till the cows come home. Just like,
I think it'll go back to being,
that'd be good for you guys. TTs here.
Sleepy. Well, I mean, the upside was pretty good too, but
yeah.
So that's gone. But I think it'll go back to being sleepy, mid-single digit arbitrage like rates of return, which is, you know, to us that's great. I mean, you look at our competition is bonds, and you look at, you know, what you're going to get paid in bonds, and a sleepy mid-single digit low volatility arbitrage strategy looks pretty darn good versus bonds. So
what's interesting to me is that there's enough of that kind of appetite in the market that with this huge increase in SPAC capital, there's still enough demand to absorb that from the non-retail crowd.
Yeah, maybe some other fund managers got turned on by it, and they was like, okay, we'll take a look at this. So maybe with you, Andrew, I had a question for you too. Like, if you're looking at the offering docs of this, and not many probably do, but you know, if you read the prospectus, like what would be like, is there any red flags in there, or is it all pretty much, I shouldn't say boilerplate because it never would be, but is it just like a SPAC is a SPAC from the offering side? It's more to do with the people behind it and the types of deals that they end up getting in, or is there any sort of red flags that people would see there?
Well, and that's one of the things that the SEC is now looking at is the quality of disclosure about the sponsor team, about their business plan and their methods for you know, identifying and assessing the targets. And then also the level of disclosure in the second stage, when you have to put out the proxy materials for the shareholder vote. You know, I think the level of disclosure is seen as much better than the level of disclosure in the IPO. And I think that where the regulators are looking at the risk to retail investors and to others is in that period between the IPO and the deal announcement, when you have, for arguably no good reason other than the hype and reputation of the sponsor, something trading from 10 all the way up to 60. And there may be good reasons for something to be 60, but I think the prevailing view right now is that there weren't. And so the point is to have increased disclosure at the IPO stage so that investors can understand better what and who they're backing before any deal is announced.
And you said before that people the SPAC can't know what they're going after. They can't say, or they can't maybe have an inkling. I don't know how you work on that, but like if they don't really not quite sure what they're doing, necessarily when they do the when they release a SPAC, how do you see from say the other side? Maybe any of you, like if an investor is in a company and like maybe one of Brian's companies, and they're saying, hey, I can SPAC this, sell it to a SPAC, or I can just IPO, or the good old reverse takeover, which probably has its own kind of laundry with it too, but SPAC's obviously a lot cleaner maybe because it's a brand new thing. But like how do people choose on that side, on the investor side, to go down one of those two, which is like the title of our session here? Why SPAC versus IPO, and is it different in say Canada and the US? I don't know if Travis or Tom, especially from the Canadian side, and then Andrew, of course, knows the US.
I mean, I could touch on that briefly. There are advantages to the SPAC versus the IPO, as Andrew has talked about from a regulatory perspective. Even though we're calling it an alternative to an IPO, it's actually a merger. You're merging with a SPAC. And so that's regulated differently than an IPO. In fact, there's a different sort of legal document underpinning it as an S4 versus an S1. And within that different framework, there are different opportunities for disclosure. You can make forward-looking statements. And there are different opportunities for due diligence. You can become restricted in the securities, go over the wall, and do due diligence on that. So, for sort of late-stage venture companies where all the value is in the future, being able to make those forward-looking statements is pretty valuable. And I think there's no coincidence why we've seen so many of those go public via the SPAC route. So yeah, I'll pause there and let anyone else jump in.
And the S4 is US, I guess, eh? And then is there anything like particularly in Canada? Are there many Canada SPACs? Maybe Travis, have you been in those trades, or?
There's been a few Canadian SPACs listed on the NEO exchange in general. So a lot less liquidity than the US SPAC. They're pricing in US dollars, but listed on a Canadian exchange typically. Fewer of them, smaller, not getting the attention that certainly the US SPAC listed universe is getting either from retail or institutions. The same arbitrage opportunity exists, but I would argue the upside optionality has proven to be less, on the excitement of a well-received deal announcement in Canada. But I think I'd echo Tom's very good comments on SPAC versus IPO. Some key differences there. I always look at the incentives that either the SPAC sponsor has, and Andrew covered those, or the company, why they would choose that's merging into a SPAC vehicle, why would they would choose that versus an IPO. And Tom covered it well. It's about disclosure, forward-looking statements, speed to market as well, a number of factors.
And what we're seeing in many deals, especially where there's an auction, is that the people at the table are some private equity funds, maybe some strategics, and now at least one SPAC. And so for the entrepreneur's perspective, those are the three main exits. And I think we've said already, it may not, being a public company may not be the right answer for everyone, but you have that opportunity now. I think it's also worth looking at what is the business plan after the merger? Who from the SPAC sponsor is going to stay involved with the company? And who from the management team of the private company may not stay involved now that it's a public company? And what does that picture look like? And does the de-SPAC or post-de-SPAC board add value that you wouldn't have in one of the other contexts? And maybe it does, maybe it doesn't, but I think that's part of the calculation.
Very cool.
But I could give you like just some perspectives, I guess, from the investor side. I guess if you're looking at it from, let's say, a smaller staff single family office, or even a smaller staff like private equity group, or affluent investor group, certainly you're looking at the promoter first. I mean, I think there's really three parts we're all looking at, and because the promoter, for the most part, they're outsourcing a lot of the downside. So you really have to look very closely at the promoter and ultimately their capacity to not only attract, but I know, as you mentioned earlier here, diligence deal flow. So I think those are two things that certainly on the front end, but just expanding off of looking at the individuals involved in the backstory here is, from an operational and practitioner perspective, what track record and skills do they bring to the table? Do they have skills to continue to scale, beyond, where they're at this point? And then also, I think something that's very, very underrated from an investment standpoint is just looking at evaluating the self-awareness of the people that are involved, of their competency gaps. And as an investor, and this really gets into part, 3 of what, my comments are here is, I always look at it this way, because I know, in the family office circles, you hear a lot about clubbing and co-investing and so forth. And there's positives and negatives to that. But one of the things historically is that I just feel like your investments perform better when you're investing in areas where you have, some deep domain expertise, where not only are you bringing your capital to the table, but you're also bringing value to the table as well, versus, being involved and putting your cash into, businesses or concepts that, you have no experience, no domain expertise. Because ultimately, at the end of the day, when you go outside the investment, you're in the real business world, and it doesn't matter, geographically or what market cycle you're in. Things happen in business every day. There's always, some negative situation that happens where, you could be in a great market cycle, you lose a top client or customer, or some other weird situation happens. And I'll tell you, just from where I sit in the last 18 months, some of the businesses that I've touched and have been involved with, I could write a book on some just strange things that have happened that nobody would believe. And in fact, I would title it 365 days of things that happen inside a family office that they don't discuss at conferences. And it's bizarre, but ultimately things happen. As an investor, you want to be able to have the value to step in and help resolve that problem. Because if you are not in that position, the problem's just going to get worse, and ultimately it's your cash at stake. So I just think that's always a perspective, more on the speculation side, obviously, I think more so than the the arbitrage side. But that's something definitely for certain types of investors to keep in mind.
Well, there's two things there: the value professionals being in this market, I guess, and also you have a great calendar idea, so you can sell that if people actually have actual calendars they rip off a day, like the old Far Side ones. That's great. So here's something when I was doing my research. I know we probably don't have a lot of time left here, we're getting close to the hour, but what SPAC managers would do, like hedge funds, and I'm not sure if Picton or if Maxam does this, but they would go in, like there's $6 million at risk typically, I hear. And if nothing happens in the 2 years, then that $6 million is gone. So this promoter sponsor, that's like, okay, that's our risk money. And so a hedge fund would come in and say, okay, I'm in for half of that. Yeah, I'll give you $3 million and do a few of those trades, obviously, to diversify. And then they would get, a chunk of the IPO allocation and also a block of the votes, which kind of helps it go through when they have, like, I think it's like 20% of the votes when a target is found. So, I mean, on the plus side, that enables everybody to diversify a bit more rather than having all the eggs in one basket. But you also have this voting block that will probably do it. I don't know what you guys have seen of these types of transactions, but the managers I talked to in New York are like, yeah, we got guys doing this all day and getting into all these different SPAC deals and throwing down X million to be into these transactions. You guys see that affecting it at all, or is any sort of like moral hazard in that? Because then they're probably going to vote to have it because they got $3 million at risk now, so you're probably going to vote your 20% one way. But
Yeah.
what do you guys have to say from the arbitrage side?
I can go very quickly. I mean, that's not something we would entertain doing in our arbitrage fund. We're looking to hit mostly singles. We're going to hit the odd double in that fund and the odd triple if something.
Yeah, because this is a total different risk.
Yeah, it's a different level of risk. Again, it's the unique feature of the redemption value at the trust value of the SPAC that really underpins our arbitrage approach. We've had the opportunity actually recently to maybe tells you where the market's going. If a New York firm reached out to a little firm in Vancouver,
or a big one,
had the opportunity to invest in on the sponsor side and
yeah,
looked at it. It was interesting. We would not do that in our arbitrage fund. It's a different type of investment, different risk profile. The opportunity we saw, the investing alongside the SPAC sponsor, they wanted you to basically, you're signing off that you're going to vote in agreement with the merger. So it didn't look like you got much of a choice in the opportunity we looked at. I don't know if that, maybe Andrew could comment more if that's typically written into those transactions at that stage, but again, not something we'd look at in the arbitrage fund.
Yeah, I mean, that is fairly common, that if you're in there as part of the risk capital, you're going to vote yes on the deal. I think that whether it's from a hedge fund perspective or a number of the family offices that I work with have also been in that risk capital piece, and then many are in the pipe because you get a look at the deal, but I think what's interesting is if you are otherwise inclined to invest in private equity, you're going into a fund where you like the sponsor of the fund, but you are signing away any vote on the deals that the sponsor goes and does with your money. If you take the same sponsor and you put them in charge of a SPAC, the investors do get a vote on the deal. And so that's a bit of optionality that an investor might say, well, I like the SPAC vehicle format better than a private equity fund format. And then you also have the downside protection that we've been talking about this whole time. So, yes, SPACs are sold publicly, retail investors can invest in them. But I think there's still a fair amount of motivation from professional, and family office investors who are looking at that from a speculation standpoint, and it's a different way for them to access a certain slice of the market.
Very cool. How about you, Tom? We got about a minute here.
Yeah, I was just going to say, we do that. We've been involved in risk capital transactions. I wouldn't say there's a moral hazard problem. I'd say there's an adverse selection problem, which is that the SPACs that are looking for partners on the risk capital tend to not be the best SPACs and the best sponsors. The AAA guys that everybody knows from reading the Wall Street Journal, they don't need our capital. So we passed on about 95% of those opportunities. But we have selectively participated in them in some, and they've been tremendous wins for us. It's no secret how, you know, you can read in the papers how good the economics are to the sponsors, and that's what being a risk capital participant is. You're effectively like a co-sponsor. So so we do participate in them. And then the other distinction I would make is that you know, the vote is, you know, one of the big developments in SPACs 10 years ago was separating the vote from the redemption. Those are two separate things. So voting for a transaction does not mean that you are not redeeming your capital and that you are, you know, rolling your capital. So you can be a SPAC sponsor and own common shares, IPO public securities of a sponsor, of a SPAC rather, and still redeem them. There's no sort of commitment from that perspective.
Yeah.
Wow. Good. Thanks. We got negative 10 seconds or 2 minutes. So Brian, are you into this now? Yes or no?
No, well, as I said from the beginning, you know, it's been a tremendous you know, vehicle for many years now, you know, and you know, as I you know, reiterated, certainly for a niche, you know, type of you know, I believe demographic, and you know, but at the same time, just like any other investment, you know, there's risk, and you know, just like Tom mentioned, you know, he turns down 95% of the opportunities. No different than, you know, looking at you know, real estate transactions or traditional, you know, private equity, you know, manufacturing, you know, companies. You know, you're turning down and saying no to 95% of the transactional flow coming across your desk. So it just, you know, comes down to, you know, alignments of interest, who are the people involved, and you know, taking a look to see if, you know, your risk aligns with, you know, what you're out, you know, what you're looking for in your outcomes. And I believe that's no different than the traditional, you know, investment world. At the end of the day, this is just a different vehicle. And clearly, I mean, we have some tremendous people. Travis, Andrew, and Tom are, you know, fundamentally sound, experienced, amazing people that really understand this space. So I think this was a great discussion.
Awesome.
Yeah, thanks.
Brian.
You're awesome too, Brian.
Thank you.
All right. Well, yeah, thanks all of you for, yeah, I'd say a really interesting discussion. I can say that my SPAC knowledge is pretty limited before today, and probably still is a little limited, but certainly more expanded after listening to you all. So I'm sure all of our attendees can probably say they've taken something away as well. So I'm glad you were able to join us, and I hope you're able to join us again in the near future. It sounds like maybe the SPAC space is not necessarily going to maintain this same type of growth that we've seen, but it's not going to become irrelevant either. So as things continue to evolve, we hope we hear from you again. And as an expression of our appreciation, CFA Society Winnipeg is going to be making a donation in your names to Youth Employment Services. It's otherwise known as Yes Manitoba, and it's a local nonprofit organization that's dedicated to helping youth enhance their skills and find and retain employment. Obviously, in the COVID job market, their help is needed more than ever. So, also going to say thank you to Eva Swan for helping to get this event coordinated and making it possible. And thank you all for taking the time to virtually join us today, everyone who signed in. We're going to keep these virtual events coming as we still await a return to semi-normalcy where we can all meet in person again. So keep your eyes out for the next invite, and we hope you'll all join us again. But in the meantime, take care and stay safe.
Great. Thanks, Vic. Thanks, everybody.
Thank you.
All right.
Thank you. Take care.